In this video, we're going to talk about calculating ATR, which is average true range, and using it as a stop loss. Stay tuned. Hey traders, a very warm welcome to you. Okay, so you may be familiar with this, you may not. ATR is average true range. Let's take out the average part of that for now and just focus on true range. So what is true range? Well, easy way to look at it is, generally speaking, true range is going to be your high minus low. However, it's going to be different if your close falls outside of that high minus low, because it takes into account any potential gap you've got, how far the close away was. So it gives you more, it's better for a swing trading look at things. So we're looking at a daily chart, each candle represents a daily. I want to see how much this stock is basically moving, and it includes gaps. If we're looking intraday, we're looking at 15-minute candles, we're obviously not going to get gaps, or very, very rarely going to get gaps. So it is just going to be the high minus the low. But let's look at it from a swing trading perspective now. So we've got high minus low, which is here. We've got this one here, which is high minus our previous close. And we have to nominalize that to be a positive number because we want a positive number. So we need an absolute value. So in this case here, we've got the high, the price has gapped up. So our average true range, or our true range, is going to be based on this high versus the prior day's close. And then if we look at number 3, which is number 3 here, slightly wrong order, but you get the point. 3 here. Let's just move it so we can see. That's that one, that's that one, this is this one here. That our low, we gapped down on this one, so the close is higher. So instead of taking the high minus the low, we're using the prior day's close. And then again, we've got to have an absolute value to give us a positive number. So generally speaking, this is what we're going to, most of the time, we're going to get high minus low, because it's telling us the kind of range of the day, how much this thing is, how volatile it is, a measure of volatility. And so how would we use that as traders? Well, the thing is, when we're trading, we want to know how volatile an instrument is, so we know how much risk we can give it, how wide our stop has to be, all these other things. Maybe it's outside of our range of trades that we want to take. Maybe we don't trade something that's too volatile. Maybe we don't trade something that's too quiet. Maybe we can use it to identify periods where we're shifting from high volatility to low volatility that maybe gives us a trigger to take a trade. All sorts of reasons. Very, very, very useful tool. ATR, very handy for many, many things. But let's talk about stop placement. So if we're a day trader, how would we use stop placement? ATR, we might say, okay, well, the current ATR is 110 points on the day, and we are going to trade with 50% of the ATR. So we take 50% of our 110 and we'd use that as our maximum day trading stop. But more likely, if we're swing trading, we're going to say, okay, the true range, and actually I've moved on a little bit too far here. True ranges, we get our number here. Average true range is literally, as it says, guys, it's basically the true range of one day, the true range of the next, the true range of the next, the true range of the next, and the average is how many of those we take. Standard is normally 14 periods, so that means 14 days. We take the average of the 14 days. So sum them all up, divide them by 14, there's your average. So it kind of gets out a few of the big days and the small days, and it gives us a good average. And we can adjust that to suit. We can go longer period if we're trading a kind of longer time frame trades, shorter period if we're trading shorter time frame trades. You get the idea. So that's the average true range. So if our average true range is 110 points, perhaps from a swing trading perspective, we're going to say, well, actually, each day it's the kind of expected move we're going to get in this market. Why don't we have a multiple of that? So if we're looking for a many month move, we may say, okay, well, let's do 3 times the average true range, 300 point move, 300 points, because we're looking for, 1,000 point move on the trade or whatever it may be. However we frame that, and again, that's very individual to you and to the kind of strategy you're taking. Perhaps if you're buying a double bottom, you don't need many multiples of the ATR. You can say, well, one ATR will do me, because if it's right, I am assuming I'm not going to get a full day against me, a full day's range against me, so I'll just use one ATR. Or let's say you're kind of not really finessing your entry too much, and you say, well, actually, I know I've got to give it a bit of wiggle room. I'm going to use 3 times my ATR because I'm looking for a much broader move, It could be a stock, maybe that's, you know, $5 per day or something. I'm gonna give it $15 kind of window of operation, a stop loss, a kind of hard stop. Maybe I'll reassess some in between that, but I've got to expect that, because I've got to expect that I'm not going to pick that sweet spot. It's just giving you the gauge of kind of how active and how much this thing moves, so you're not setting your stop loss too tight. There's no point in doing a swing trade and setting your stop loss at 20 points if you're kind of taking a swing trader's entry and you want to give it room and you don't want to let it breathe and you kind of don't want to get pinged out on noise. Vice versa, you know, if you're a day trader, you probably don't want to give it a 220 point stop, because it's going to close before it hits that. And so, you know, understanding how volatile the instrument you're trading is very important to being able to trade it effectively, so you can have the maximum size that you can while still managing your risk. You're not going to get stopped out all the time just on noise, because you understand kind of what the noise level is of it, and it keeps you away from stuff you don't want to be trading. If you don't want to be trading quiet stuff, you don't have to trade it. You don't want to trade in volatile stuff, you don't have to trade it. So very, very useful tool, guys. That's kind of how you calculate it manually, but it's on your charting packages. I would say all of the charting packages out there, anything that's got a chart, you can put your average true range in, but that understanding kind of how it's calculated and what it's showing you is good to come be able to visualize it and see what's going on, and then implement it into your trading plan if it suits. All right, guys, take care. Good trading. Keep the risk managed. I will see you in the next one. Goodbye.